I need to warn you about something that most investors refuse to accept. The stock market is going to crash again. I do not know if it will happen next month or next year or in 5 years, but I know with absolute certainty that it will happen. It has happened repeatedly throughout history, and there is nothing special about our current era that exempts us from this reality. The 1929 crash wiped out 90% of stock values. The 1973 crash destroyed half of investor wealth. The 2000 dot-com bust erased trillions. 2008 nearly brought down the entire financial system. And each time, most investors were caught completely unprepared. But here is what fascinates me as someone who has spent decades studying market crashes and the companies that survive them. There are certain businesses that not only survive every crash but actually emerge stronger on the other side. These are not ordinary companies. They possess specific characteristics that allow them to weather any economic storm, any financial panic, any market collapse. And if you own these businesses before the next crash hits, you will not just survive, you will thrive while everyone else is panicking. I have spent the last several months doing something that most analysts consider a waste of time. I went back through nearly a century of market data, examining which companies survived the crash of 1929, the crash of 1973, the crash of 1987, the dot-com collapse of 2000, the financial crisis of 2008, and the pandemic crash of 2020. I was looking for patterns, for the common characteristics that separate survivors from casualties. And what I found will fundamentally change how you think about building a crash-proof portfolio. Let me take you back to the summer of 2005, because that was when I first truly understood what makes certain companies nearly indestructible. I was deep in my analysis of the housing market, seeing the massive bubble that almost nobody else could see. But I was not just looking at housing. I was studying which companies would survive when the bubble burst and which would be destroyed. I remember pulling up the historical data on companies that had existed during the Great Depression. Most of the names were unfamiliar, companies that had long since gone bankrupt or been absorbed by competitors. But a handful of names kept appearing decade after decade, crash after crash. These companies did not just survive the Depression. They survived the 1937 crash that followed. They survived World War II. They survived the inflation crisis of the 1970s. They survived every single market disruption for nearly a century. I became obsessed with understanding why. What made these specific companies different from the thousands of others that had failed? The answer I discovered was not luck. It was not even superior management, though, that helped. It was something more fundamental, a set of structural characteristics that made these businesses nearly impervious to economic catastrophe. That research shaped how I invested through 2008. While most investors were watching their portfolios collapse, I had positioned myself not just to avoid losses, but to profit from the crisis. And the companies I identified as crash survivors back then continued to prove their resilience through the pandemic crash of 2020. The pattern holds, it always holds. I remember calling my research analyst in the fall of 2008. The market was in free fall. Lehman Brothers had just collapsed. People were genuinely wondering if the entire financial system was going to fail. He asked me what we should do, whether we should sell everything and go to cash. I told him to look at the dividend announcements from the companies on our survivor list. Johnson & Johnson had just raised their dividend. Procter & Gamble had raised their dividend. Coca-Cola had raised their dividend. In the middle of the worst financial crisis since the Great Depression, these companies were sending more cash to shareholders than ever before. That moment crystallized something important for me. The stock market was panicking, but the actual businesses were fine. They were selling products, they were generating profits, they were rewarding shareholders. The gap between market perception and business reality was enormous. And that gap represented opportunity. We did not sell, we bought more. And by 2012, those positions had more than doubled, while many investors were still recovering from their panic selling in 2008. Today, I am going to share 5 stocks that have survived every major crash since 1929. More importantly, I am going to explain exactly why they survived, what characteristics they share, and how you can use this knowledge to protect your own portfolio before the next crash arrives. Because make no mistake, another crash is coming. The only question is whether you will be prepared. Before I reveal the specific companies, let me explain the framework I use to identify crash survivors. This framework has three components, and a company must possess all three to qualify as truly crash-resistant. The first component is what I call essential demand. The company must sell products or services that people need regardless of economic conditions, not want need. When the economy collapses, consumers cut spending on luxuries, on entertainment, on discretionary purchases, but they continue buying essential goods. They continue eating. They continue taking medicine. They continue using electricity and water. Companies that provide these essentials see their revenues remain relatively stable even during severe recessions. The second component is pricing power. It is not enough to sell essential products. The company must be able to maintain or increase prices even when the economy weakens. This typically comes from strong brands, from lack of substitutes, or from some form of structural advantage that prevents customers from switching to competitors. A company that sells essential goods but faces intense price competition will see its profits collapse during a crash, even if revenues hold steady. The third component is financial fortress. The company must have a balance sheet strong enough to survive extended periods of economic stress. This means low debt relative to cash flow, substantial cash reserves, and the ability to continue operating and even investing when credit markets freeze. Many otherwise strong companies failed during 2008, not because their businesses were bad, but because they had too much debt and could not refinance when credit dried up. I have analyzed hundreds of companies that failed during major crashes, and the pattern is remarkably consistent. They almost always had too much debt. They relied on the credit markets to fund operations or roll over existing borrowings. When credit dried up, as it always does during severe crashes, they were caught in a death spiral. Good businesses with bad balance sheets become casualties. Mediocre businesses with fortress balance sheets survive to fight another day. There is actually a fourth component that I consider a bonus criterion, though not strictly required. Long dividend histories. A company that has paid and preferably increased dividends for 50 or 60 consecutive years has demonstrated something profound. It has proven that its business model works across multiple economic cycles, across different management teams, across changing consumer preferences and technological disruptions. A 60-year dividend growth streak is not luck. It is structural advantage made visible, essential demand, pricing power, financial fortress. These three characteristics are the common thread connecting every company that has survived every crash since 1929. Now let me show you the 5 specific stocks that exemplify these qualities. The second stock on my list, and I am starting here because understanding this company will help you understand all the others, is Procter & Gamble. This company has been in continuous operation since 1837. Think about that for a moment. This business has survived the Civil War, 2 world wars, the Great Depression, and every market crash in American history. It is not just a survivor. It is the ultimate survivor. Procter & Gamble makes products that are so deeply embedded in daily life that most people use them without even thinking. Tide detergent, Gillette razors, Pampers diapers, Crest toothpaste, Charmin toilet paper. These are not luxury goods that people stop buying when times get tough. These are products that people buy week after week, month after month, regardless of what the stock market is doing. During the 2008 financial crisis, when the S&P 500 fell 57% from peak to trough, Procter & Gamble stock declined only about 30%. That is still painful, but it is nearly half the loss of the broader market. And here is what really matters. The company continued paying and increasing its dividend throughout the entire crisis. Investors who own Procter & Gamble receive cash payments every quarter, money they could use to buy more shares at depressed prices, or simply to pay their bills while waiting for the recovery. The company has increased its dividend for 67 consecutive years. Let that sink in. Through every recession, every crash, every economic crisis since 1957, Procter & Gamble has raised the amount of cash it pays shareholders. This is not an accident. It is the result of a business model designed for survival. Here is what makes Procter & Gamble nearly crash-proof. First, essential demand. People do not stop washing their clothes during recessions. They do not stop brushing their teeth. They might trade down from premium brands to store brands in some categories, but Procter & Gamble owns brands across multiple price points. They capture consumers whether times are good or bad. Second, pricing power. These brands have been building consumer trust for decades, in some cases for over a century. When you reach for Tide or Gillette, you are not making a purely rational economic decision. You are choosing brands that have become synonymous with quality in their categories. This emotional connection gives Procter & Gamble the ability to raise prices faster than inflation, protecting profit margins even when input costs rise. Third, financial fortress. Procter & Gamble generates over $15 billion in free cash flow annually. The company carries debt, but that debt is easily serviced by the massive cash flows from operations. During the worst of 2008, when other companies were desperately cutting costs and slashing dividends, Procter & Gamble was buying back stock and investing in new products. They emerged from the crisis stronger than when it began. Now, let me tell you about the first stock on my list, and this is the one I consider the single most crash-resistant company in the world. Johnson & Johnson has not just survived every crash since 1929. It has thrived through them, using periods of economic stress to acquire competitors, expand into new markets, and strengthen its competitive position. Johnson & Johnson operates in three segments: pharmaceuticals, medical devices, and consumer health. Each of these segments benefits from the same fundamental truth. People do not stop getting sick during recessions. They do not stop needing surgery. They do not stop buying Band-Aids and Tylenol. Healthcare demand is as essential as it gets. But what sets Johnson & Johnson apart from other healthcare companies is the diversity of its business. Many pharmaceutical companies depend on a handful of blockbuster drugs. When those drugs lose patent protection, revenues can collapse. Johnson & Johnson has so many products across so many categories that no single drug or device can materially impact the overall business. This diversification provides stability that pure-play pharmaceutical companies simply cannot match. During the financial crisis of 2008, Johnson & Johnson stock fell only about 30% while the broader market collapsed nearly 60%. The dividend was not just maintained but increased. And here is the remarkable statistic. Johnson & Johnson has increased its dividend for 62 consecutive years. For more than 6 decades, through every recession, every market crash, every economic crisis, the company has raised the cash it pays shareholders. That track record is not luck. It is the result of a business built to survive. I want to tell you a story that illustrates why Johnson & Johnson belongs in every crash-proof portfolio. In 2009, at the depths of the financial crisis, I met with a fund manager who had liquidated almost his entire portfolio in late 2008. He had gone to cash, convinced that the entire financial system was going to collapse. And he was not entirely wrong about the risks. But by going to cash, he missed the recovery. The market bottomed in March 2009 and then doubled over the next 2 years. Meanwhile, an investor who had simply held Johnson & Johnson through the entire crisis collected dividend payments every quarter, reinvested those dividends at depressed prices, and emerged from the crisis with more shares than they started with. By 2011, that investor had fully recovered, and then some. The fund manager who went to cash never caught up. His attempt to avoid losses caused him to miss the gains. There is another aspect of Johnson & Johnson that makes it particularly valuable during crashes. The company operates globally, with sales in virtually every country on Earth. This geographic diversification means that even if the American economy collapses, the company continues generating revenue from Europe, from Asia, from Latin America. A recession in one region is partially offset by growth in another. This global footprint is something that most investors overlook when evaluating crash resistance. During the 2008 crisis, I studied which companies were maintaining their international operations while others were retrenching. Johnson & Johnson was actually expanding its presence in emerging markets, using the crisis as an opportunity to gain market share, while competitors were distracted by survival. By 2012, those emerging market investments were generating billions in additional revenue. The company had used the crash as a springboard for growth rather than merely trying to survive. The lesson is not that you should ignore crash risk. The lesson is that if you own the right companies, companies like Johnson & Johnson, you do not need to time the market. You do not need to predict when crashes will happen or when they will end. You simply hold quality businesses through the volatility and let time work in your favor. The third stock that has survived every crash since 1929 is one that most growth-oriented investors overlook. Coca-Cola might seem boring compared to the latest technology darlings. It sells flavored sugar water. How exciting could that possibly be? But that boringness is precisely what makes Coca-Cola nearly indestructible. Coca-Cola has been selling essentially the same product for over 130 years. The formula does not need to change. The business model does not need to pivot. The company does not need to constantly reinvent itself to stay relevant. It just needs to keep doing what it has always done, selling beverages that people enjoy drinking. During the Great Depression, when unemployment reached 25% and millions of Americans could barely afford food, Coca-Cola remained profitable. The company reduced prices and introduced smaller bottle sizes to keep its products affordable. But people kept buying because when life is miserable, small pleasures become more important, not less. A cold Coca-Cola costs pennies but provides a moment of genuine enjoyment. That psychological dynamic has protected Coca-Cola's business through every economic crisis for over a century. Here is what I find remarkable about Coca-Cola's crash performance. During the 2008 financial crisis, the stock declined only about 25%, while the S&P 500 fell nearly 60%. The dividend was maintained and increased throughout the crisis, and by 2010, Coca-Cola stock had fully recovered to pre-crisis levels, while many other stocks were still down 30, 40, or 50%. The company's financial fortress is extraordinary. Coca-Cola generates over $10 billion in free cash flow annually. It carries debt, but that debt is dwarfed by the company's ability to generate cash. More importantly, Coca-Cola has one of the strongest brands in the world, worth billions of dollars that do not appear on any balance sheet. That brand value is what gives Coca-Cola its pricing power, its ability to charge more than generic alternatives, and still maintain market share. Coca-Cola has increased its dividend for 62 consecutive years. Matching Johnson & Johnson's remarkable track record, this consistency is not coincidence. Both companies share the same fundamental characteristics that enable crash survival: essential demand for products people use, daily pricing power from brands that have built trust over generations, and financial strength that allows them to maintain dividends and invest through downturns while weaker competitors struggle. I often think about what would happen if you had invested $10,000 in Coca-Cola at the peak of the market before the 1987 crash. The stock would have fallen significantly. You would have watched your investment drop by 30% in a matter of days. Most investors would have panicked and sold. But if you had simply held, reinvested the dividends, and ignored the noise, that $10,000 would be worth over $500,000 today. Not because of any brilliant market timing, not because of any special insight, simply because you owned a great business and gave it time to compound. The fourth stock on my list might surprise you because it operates in a sector that many investors consider risky. But ExxonMobil has survived every crash since 1929, and its track record reveals something important about what truly makes a company crash resistant. Energy companies are cyclical. Oil prices rise and fall dramatically. Revenues and profits can swing wildly from year to year. This volatility scares away many conservative investors. But ExxonMobil has navigated this volatility successfully for over a century because of how it operates within the energy sector. First, scale. ExxonMobil is one of the largest energy companies in the world. This scale provides cost advantages that smaller competitors cannot match. When oil prices fall, Exxon can continue operating profitably at price levels that would bankrupt smaller producers. This allows the company to survive downturns and then acquire distressed competitors at bargain prices. Second, integration. ExxonMobil is not just an oil producer. It is an integrated energy company that operates across the entire value chain, from exploration and production to refining and retail. When crude oil prices fall, refining margins often expand because refineries can buy their input at lower prices. This integration provides natural hedging that smooths out the volatility of pure-play producers. Third, financial discipline. Unlike many energy companies that loaded up on debt during the shale boom, ExxonMobil has maintained a conservative balance sheet. The company can survive extended periods of low oil prices without cutting the dividend or selling assets at distressed prices. This financial strength has been tested repeatedly, most recently during the pandemic, when oil prices briefly went negative. During the 2008 financial crisis, ExxonMobil stock fell about 35%, less than the 60% decline in the broader market. The dividend was maintained throughout, during the pandemic crash of 2020. The stock fell significantly, but the dividend was again maintained. ExxonMobil has paid a dividend every year since 1882, over 140 years of consecutive payments through 2 world wars. The Great Depression, multiple oil price collapses, and every financial crisis in modern history. I want to address something that concerns many investors about energy companies. The world is transitioning away from fossil fuels. Electric vehicles are growing rapidly. Renewable energy is becoming cost competitive. Does this mean ExxonMobil will eventually fail in the very long term? Perhaps decades from now, the energy landscape will look dramatically different. But in the medium term, the next 10 to 20 years, the world still needs oil and gas. Billions of people in developing countries are just beginning to enjoy the benefits of modern energy. Demand is not going away anytime soon. More importantly, ExxonMobil is not standing still. The company is investing heavily in carbon capture technology, in biofuels, in hydrogen production. It is positioning itself to be a major player in whatever the future energy landscape looks like. Companies that have survived for over a century have done so by adapting to changing conditions. I expect ExxonMobil to continue adapting. The key insight about ExxonMobil is that energy demand is essential demand. People need to heat their homes. They need to transport goods. They need to power factories. Until viable alternatives exist at scale, which will take many years, traditional energy companies will continue generating massive cash flows. And ExxonMobil will continue returning that cash to shareholders through dividends. Now, I need to tell you about the 5th stock, and this one is critical for understanding why certain companies are nearly indestructible. Colgate-Palmolive has been in continuous operation since 1806. That is over 200 years of survival through every imaginable economic and political disruption. The company predates the Civil War, predates electricity, predates automobiles, and it is still here, still profitable, still paying dividends. Colgate-Palmolive makes products that are so mundane, so unremarkable, that most people never think about them. Toothpaste. Soap cleaning products, these are not exciting businesses. They do not generate headlines. They do not attract attention from growth investors looking for the next big thing. But that boring reliability is precisely what makes Colgate-Palmolive crash-proof. Think about your own behavior during economic stress. When money is tight, when you are worried about your job, when the stock market is collapsing, you cut back on all sorts of spending. You skip restaurant meals, you postpone vacations, you delay buying a new car. But do you stop brushing your teeth? Do you stop washing your hands? Do you stop cleaning your home? Of course not. These are non-negotiable expenses, small enough that cutting them would save almost nothing but essential enough that you would never consider it. Colgate. Palmolive has increased its dividend for 61 consecutive years, through every recession since 1963, through every market crash, through every economic crisis. The company has raised the cash it pays shareholders. This is the essence of crash resistance. A business so fundamental to daily life that economic conditions barely affect it. During the 2008 financial crisis, Colgate-Palmolive stock declined only about 20%, while the broader market fell nearly 60%. The dividend continued rising throughout. By 2010, shareholders had fully recovered and were earning higher dividends than before the crisis began. The same pattern repeated during the pandemic crash of 2020. The stock fell briefly but recovered quickly while the dividend continued its unbroken streak of increases. Now, let me pull together the synthesis of everything I have shared. These 5 companies, Johnson & Johnson, Procter & Gamble, Coca-Cola, ExxonMobil, and Colgate-Palmolive, share characteristics that explain their crash survival. And understanding these characteristics is more important than memorizing the company names. First, they all sell products that people need regardless of economic conditions: healthcare, hygiene, energy, beverages. These are not discretionary purchases that consumers can easily eliminate. They are embedded in daily life. Second, they all possess pricing power derived from decades of brand building. These companies charge premium prices for products that could theoretically be purchased more cheaply from competitors. But consumers continue paying the premium because they trust these brands. That trust was built over generations and cannot be quickly replicated. Third, they all maintain conservative balance sheets that allow them to survive extended periods of economic stress. They do not rely on debt to fund growth. They generate substantial cash flow that exceeds their investment needs. They can continue operating normally when credit markets freeze and weaker competitors struggle to survive. Fourth, they all have diversified revenue streams that prevent any single product or market from causing catastrophic losses. Johnson & Johnson has pharmaceuticals, medical devices, and consumer products. Procter & Gamble has dozens of brands across multiple categories. This diversification provides resilience that concentrated businesses cannot match. Fifth, and this is perhaps most important, they all have survived previous crashes, proving that their business models work in crisis conditions. Past performance does not guarantee future results. But a company that survived the Great Depression, the 1973 crash, 1987, 2000, 2008, and 2020 has demonstrated resilience that cannot be easily dismissed. Now, let me tell you how to actually apply this knowledge to your own portfolio, because understanding these principles is worthless if you do not act on them before the next crash arrives. The first step is to assess your current holdings. Look at each stock in your portfolio and ask whether it possesses the 3 essential characteristics. Does it sell products or services that people need regardless of economic conditions? Does it have pricing power that protects profit margins during downturns? Does it have the financial strength to survive extended periods of economic stress? If a stock fails any of these tests, you should consider whether it belongs in a crash-resistant portfolio. I do this analysis quarterly with my own holdings. I pull up the financial statements and ask hard questions. Has debt increased relative to cash flow? Have profit margins declined, suggesting weakening pricing power? Has revenue growth slowed in ways that might indicate declining demand? These are warning signs that a company might be losing its crash resistance. Better to identify problems early and make adjustments than to discover weaknesses during a crisis when it is too late to act. The second step is to build positions in crash survivors before you need them. The worst time to buy defensive stocks is during a crash, when everyone else is also seeking safety. Prices rise as panicked investors pile into the same handful of names. The best time to buy is when markets are calm, when no one is worried about crashes, when defensive stocks seem boring compared to the high-flying growth names making headlines. Right now, as I record this, most investors are focused on artificial intelligence stocks, on cryptocurrency, on whatever is generating excitement and headlines. The companies I have described, the boring dividend payers, are being ignored. Their prices are reasonable. This is exactly when you should be building positions. Not because I know when the next crash will happen, but because I know it will happen eventually, and these companies will protect you when it does. The third step is to maintain discipline during the crash itself. The companies I have described will decline during market crashes. Every stock declines during crashes, but they will decline less than the market, and they will continue paying dividends, and they will recover faster. Your job during a crash is simply to hold on, do not panic, do not sell at the bottom. Do not try to time the market, just hold quality businesses and let time work for you. I want to leave you with something that matters more than any specific stock recommendation. The next crash is coming. I do not know when, and neither does anyone else, but I know it will happen because crashes always happen. They are a feature of capitalism, not a bug. The question is not whether you will experience another crash, but whether you will be prepared when it arrives. The people who are destroyed by crashes are those who ignore the warnings, who convince themselves that this time is different, who load up on speculative investments because they have been going up. The people who thrive through crashes are those who prepare in advance, who own businesses built to survive, who maintain the psychological discipline to hold when everyone else is selling. You have the knowledge now. You know which companies have survived every crash since 1929. You know why they survived. You know how to identify similar companies that might not be on this list but share the same characteristics. The only question remaining is whether you will act on this knowledge or continue hoping that you can somehow avoid the next crash. I have seen this pattern repeat throughout my career. I share research with investors. I explain exactly what the data shows. I warn them about risks they are ignoring, and most of them nod politely, thank me for my time, and then do absolutely nothing. They continue holding the same speculative positions, they continue ignoring the warning signs, and when the crash comes, they are destroyed even though they had every opportunity to prepare. The few investors who actually implement these principles, who build portfolios around crash-resistant companies, who maintain the discipline to hold through volatility. They do extraordinarily well over time. Not because they are smarter than everyone else, not because they have access to better information, simply because they prepared for something that was always going to happen, and they did not panic when it did. I cannot force you to act on this information. I can only give you the tools and hope that you use them. The companies I have described will be here 10 years from now, 20 years from now, 50 years from now. They will continue paying dividends. They will continue surviving crashes. The only question is whether you will own them or whether you will be on the other side of that trade, selling in a panic while they calmly collect their dividend checks. Hope is not a strategy. Preparation is a strategy. And the time to prepare is now while markets are still functioning normally, while you can still make rational decisions unclouded by fear. Because when the crash comes, and it will come, you will not have time to think. You will only have time to react. And the quality of that reaction will depend entirely on the preparation you do today.